Welcome everyone, and thank you for joining today's Hotel Investors Marketplace webcast produced by Hotel Brokers International. I am Brandt Niehaus, President of HBI this year and President of Huff Niehaus and Associates Inc. in Louisville, Kentucky. I'll be moderating today's webinar, Lodging Industry Outlook, Stats, Trends, and Projections. While everyone is getting signed in and comfortable, we will highlight a selection of HBI member listings on the screen while I share a few items. Founded in 1959, Hotel Brokers International is the leading network of real estate brokers specializing exclusively in hotel real estate investment, providing every phase of the brokerage process from property valuation to closing. Visit HBI on the web at hbihotels.com. At any time during the webcast you have a question, just click on the Ask a Question button located at the top of the webcast player. Type in your question and submit it. We'll answer as many as our time allows. We also include some attachments, links under the Attachments button. The attachments will be available throughout today's webinar as well as available later today when the recorded event is posted for on-demand viewing at hbihotels.com. We want you to let us know how we are doing. Rate today's webcast by clicking on the Rate This button, also located at the top of the webcast player. You can do this at any time during the presentation. Please feel free to share this webcast by clicking the Share This button. Others will be able to view it on-demand viewing at hbihotels.com later today. Now I'd like to welcome Jeff Higley. Jeff oversees all aspects of Hotel News Now digital platform, including their website and daily newsletter. Jeff also leads the STR family of companies' efforts with corporate public relations and press releases, and frequently writes articles on the lodging industry on the web. Jeff is a former editorial director of Hotel and Motel Management magazine and has specialized in hotel industry journalism for many years. Welcome, Jeff. How are you today?
Brandt, thanks a lot. I appreciate you having me on. It's always good to join HBI and all of its endeavors. So I'm doing great. And how about yourself?
Just fine. You know, it's a new year and there's new business to be had.
That's right. There's a lot of and there's a lot of variables out there. That's the thing that I think we all have to keep in mind, with all the geopolitical things going on around the world. You never know when the financial picture is going to shift a little bit. I know there's a lot of people in your organization and elsewhere that are just, watching everything like a hawk to make sure if there are any indicators out there that point to a downturn, they're going to catch it right away.
Well, I'm sure in today's presentation we'll cover some of that because those factors are probably, those unknown factors are the things people want to be aware of and see what you guys are predicting and expecting and then apply that to their investment opportunities in the hotel real estate. So we can get started. I'll let you begin and sort of take over the reign and as we go through it, I'll ask questions and present any questions we see from the audience.
All right, great. Well, again, thanks for having me. Hi, everybody at HBI. Always a pleasure seeing or talking with you guys. So looking forward to another successful year of that in 2016. So we're going to start this presentation, in addition to being available through HBI, will also be on the Hotel News Now website under the Data Presentations tag. It is free of charge. A free login is required. So we'll get right to it. Now, those of you who know me know that I have pretty much an opinion about everything. So here's 5 things that I think I know, and I want to make it clear that these are my opinions, not necessarily the opinions of STR. Once we get into the data, that's obviously STR stuff. So first, the wave of mega mergers is not over. Who's going to be next? We saw Accor purchase Fairmont Raffles, and of course we saw the big one, Marriott, enter into an agreement to buy Starwood. There's a lot of talk about IHG, whether they're a buyer or a seller remains to be seen. There's a lot of talk about Chinese companies getting into the fray, wanting to get into into the North American market in a big way. So are they looking at a specific company they want to buy? And, you know, I know that Hyatt was a very active bidder in the process for Starwood, and that raises the question of would they be interested in another company that might be available out there. So it'll be interesting to see how those mega mergers advance here in 2016. On the heels of that, you've got, once this is approved, and it's got to be the Marriott Starwood deal has to not only be approved by the SEC here in the States, but in many other countries as well, the equivalent of that. So that's going to take some time. So probably by the middle of the year, end of June is I think when they have it pegged, we'll have this massive company with almost 30 brands, 1 million plus rooms, and a lot of overlap. I got to believe they have to sell some of those brands. I just can't see the owners of Marriott hotels versus the owner of a Sheraton, for instance, being happy that they're on the same distribution platform yet located on the same corner. So I think there's going to be some movement. I know Arne Sorensen, Marriott's CEO, wants to keep as much intact as possible, but I think there's got to be some strategic divestitures among the brands that Marriott has acquired. So that'll be interesting to watch.
Jeff, you don't think that they will try to continue to operate, you know, even where you have a Marriott on one corner and a Sheraton hotel on the other, with that same distribution, because they're going to be merging the distributions, so you know the customer will be able to participate at either one of them. But
that's right.
You know, but they still are two different brands providing two sort of different services.
They're two different brands, but as everybody at HBI knows, that the owner of the property might have a little bit of a different opinion on what Marriott wants to do, because I can't see many owners of Sheratons wanting to go head-to-head on the same platform with Marriott. That's not to say one brand's better than the other. I'm not here to make that judgment. I'm just saying impact issues have always been a major issue in the hotel industry, and I think this merger kind of puts some major impact issues on the table that Marriott's going to have to address one way or another. I believe it might be through the divestiture of some of those brands, but they may have another plan. They're a lot smarter than I am. They probably have another plan to handle that kind of issue with their ownerships.
It'll be interesting, that's for sure.
It is. I mean, it's fun to watch. It's really fun to watch.
I mean, there are, in that 30 brands, there's some other lesser brands that haven't really, you know, gotten traction that I think are very easily going to be spun off because there's nothing to really be done.
Spun off or merged in. You know, there could
right.
be some
they might merge them in and then just get rid of the other name. Is that what you're saying?
Yeah, that's right. Or take the cream of the crop, merge them, you know, whatever. Brand A, take the cream of the crop and put them in the Courtyard system, and let's say there's 100 properties left over, they move. But remember that, you know, Marriott owns, what, 20 properties? It's a franchising and management company. Mm-hmm. So they really do have to listen to their owners a little bit in terms of managing those expectations. So it's going to be interesting to see how that does transpire as 16 unfolds. Another interesting issue is the supply issue. We all know that supply is starting to accelerate. We'll talk about that in the data presentation. You know, how I measure it is the number of press releases that cross my desk. And the number of press releases about hotel openings has increased, I would say, 20-fold over the past 6 months. So all those properties that were built, we're seeing them come online now, and I'm sure you know, there's a lot of owners who are looking at that as a concern. I don't think we should underestimate the impact that supply has. If you're adding another 100,000 rooms to the supply chain, certainly that's got to affect someone, and you know, that's going to be interesting to watch as well.
Yeah, you may get into this in a little more detail in your slides, but the issue I have with supply is that the focus of STR and some of your competitors on tracking supply and occupancy rates is focused in the major markets, it seems, and that's where a lot of the extreme amount of building is going on, whether it's downtown Nashville or downtown Louisville, and you're in my neck of the woods, or anywhere else across the country. And it could conceivably show a softening before there really is a softening of the whole that begins to change everybody's attitude early. And I'll be curious to see how that pans out.
That's right, Brandt. We have there's a slide I think in this presentation that there is no softening right now in those markets.
Right.
Urban markets are the pipelines are chock full. I think the number about 50% of the rooms under construction in the U.S. are in the top 25 markets. So that does paint a pretty robust picture, and we all know, and we'll show the numbers. We all know New York is going crazy with the number of rooms being added to that supply. So using that as a bellwether, is there going to be a soft landing? Who knows? But is supply going to be the start of that soft landing rather than an external event like most people probably expect? It certainly bears watching.
Right.
Number 4, we've heard a lot about Airbnb and the impact that it's had. What we've seen, and full disclosure on this, with the exception of a recent release of data that Airbnb provided for the New York market, nobody really knows Airbnb data. They don't release it. It's not a public company. So a lot of the projections you see out there are really just that. They're just projections. They're educated guesses. So it is having an impact undoubtedly, but it's not a huge effect on hotels right now. But the interesting thing is going to be to watch when the downturn comes, because you have to assume that the hosts at Airbnb and all of those other sharing economy platforms are going to feel an economic pinch just like the rest of us. So will they lower their prices? And how, in an environment that low price wins, that's where I think we could see an issue. But I don't think it's anything to worry about for the next at least 12 to 18 months. And of course, near and dear to what the HPI members are, we have a few slides on some transactions in our almanac, but values are starting to top out. Is that the signal we're at the peak? I'll be interested to hear what your members say out in Vegas in a few weeks, or I guess about a month away, about this very topic. What I'm hearing now is that values are peaking, and we'll start seeing that on the downside. So how long after that will it be before the industry itself starts to see the backside? So 5 things I think I know. Only time will tell if I'm right, and my track record isn't that great. So take that all with a grain of salt. But I do have an opinion about everything, as you guys know. So let's get right into the data presentation then. We'll look at this slide here. It shows this is all data through November. Our December data will be available next week, actually, the 18th. I think it's 19th. 18th is a holiday. So you can see
you'll have that for Alice then, right?
Yes, that'll be at Alice, and then of course we'll have it in the presentation at the Vegas conference for you guys. So you can see, I mean, this is no surprise to everyone. It was a banner year in 2015, and when the December numbers come in and are final, those remarks on the right-hand side of that page aren't going to change. It's going to be a record year across the board. The times are good. I mean, there's not much else you can say about this slide. I think the most telltale piece of data on here is that 7.5% increase in room revenue. That is what, obviously that's what, that top line number is what drives a lot of companies, and then obviously the higher the top line, the more you drop to the bottom line. So record year, great performance by the hotel industry. You can see here that the blue line, which represents the demand percent change, and the red line is the supply change. As long as that blue line stays above the red line, the industry is good, and there's a pretty significant gap between those numbers right now, although the blue line is starting to trend down and the red line starting to trend up. So, extrapolating that out, obviously, if anybody here has a crystal ball and can say when those lines would cross, I would throw my $2 for a lottery ticket to find that date out, because I'd put some money on that. That's going to be a date that we'll all kind of look back on and go, there it was. That was the signal. So we got to keep an eye out for that. ADR continues to ride pretty high. You can see that RevPAR percent change. So we're looking back at early to middle of 2011 all the way through. That ADR percentage growth is at roughly 4%, give or take a few tenths of a percentage point for almost 4 years now. So that's we haven't seen those dramatic large increases of ADR growth that we saw in coming out of it in 95, or that we saw coming out of it in 2003, 2004. We saw the big jump, the initial big jump, but then it's been a nice, even, steady performance for the industry. So you have to really hand it to the hotel operators for managing their rate pretty well. Does everybody want to see higher ADR growth? Of course, it's never high enough, right? But the fact that it's hovered around that 4% growth, I think most people would say they'd rather count on that than the wild swings that you can see in some of the eras on this chart.
Well, and it looks like they did a pretty good job of holding that ADR growth even in the downturn of 13 to 14, and even currently in 15, where occupancy growth slowed. They still kept their ADR growth going, which is a positive thing for the operators.
Yeah, and that's right. And I think that speaks a lot to the fact that rates weren't jumping dramatically. It was just it was a nice even pace that consumers were comfortable with absorbing. There wasn't these exorbitant increases. Now, obviously, we all know it's a street corner business. It's a market-by-market business, and certainly there were markets that grew, and we'll talk about those in a minute, that grew huge, and others that plodded along at that 3 to 4% rate. But overall, it's been a good 4 years. I think everybody can attest to that. So we'll take a look at that RevPAR growth. Again, you can see the yellow arrows in there, how long each of these last little cycles have gone on. I always like to point out that green line. Those downturns were so dramatic, and then the volatility there in from 2000 to 2010 was just wow. We can all remember those days, and those dark days of early 2002 and 2009. You don't want to wish that on your worst enemy, so we hope we don't see those in a long time. But I think, I guess we'll see if this is a trend, that volatility of those huge drops. So we're in 69 consecutive months of RevPAR growth. You can see on this that there's a little hiccup around Labor Day of last year that saw a big decline, mainly because of the placement of Labor Day. It was a little bit later in September, so August numbers fell off pretty dramatically. But we look at that as a hiccup, not a trend. So we're pretty comfortable with that. Let's take a quick look at some chain scales. Just a quick reminder, here's some of the examples of it. You can get the entire list at the address down below, hotelnewsnow.com/chain scales. You can see here that the lower end is ruling the demand growth fueled by that upscale, the almost 5% demand growth in 2015 through November, and upper mid-scale there. And I'm just going to jump back for a second. Upscale, upper mid-scale. You can see, you're looking at the Garden Inns, the Residence Inns, Fairfields, Holiday Inns, those kind of brands. And I don't think that's to anyone's surprise. Obviously, that's what's getting built, and a lot of that's what's getting sold these days because of this kind of demand. So hopefully all of you, the brokers out there, are getting top dollar because of the demand generators and performance of those hotels. Whoops, did I skip one? Sorry.
No. Let me ask you a question just quickly. In the definition of luxury, upper upscale, you don't have to move the slide. It's just a matter of you guys categorize those based on the franchise average rate. Is that how they get put into those different categories?
That's the predominant way that the ADR is the major way. There are some other tangible, intangible things that are taken into consideration, but the primary way that we rank those is through ADR. Yes.
Okay.
Okay. So you look at this slide, you can see the upper end from upscale on up. 3 out of every 4 rooms in those 3 chain scales are occupied every night in 2015, which is the same as 2014, but just a little bit higher. So you can, again, across the board, every chain scale has seen growth in absolute occupancy, and that obviously presents a great opportunity for pricing power for the industry when those rooms are full. Move into the segmentation. You can see group business. That's been a big driver of the last few years in terms of the growth that the industry's had. We can see not quite as strong as transient in the luxury and upper upscale segments, which is where groups tend to stay, but still a pretty strong performance there, and that obviously again gives hoteliers pricing power when they know that their groups are paying more. They can also have some pricing power on the transient and other sources of business. Group demand is still, you can tell the growth slows as hotels are full because there's just no other place to put them. So this is a 12-month moving average slide here, and the demand percent change is the blue, and the ADR percent change is the green. Not much else to say here other than you can see it's a volatile performance for group, but still in the positive. Where the interesting thing is going to be how negotiations go in 2016 as that season opens in the fall for further out. So if you're booking a group business in 3 or 4 years, what kind of rates are we going to see? I would love to be the fly on the wall in a lot of those negotiations. Quick look at top 25 group RevPAR percent. You can see there on the right side, New York and Oahu, big decreases. Meanwhile, on the left side, Phoenix has rebounded really well. You can remember maybe in 2010, 2011, even into 2012, Phoenix was lagging the rest of the economy in terms of a rebound coming out of that recession, and so it seems to be starting to really catch up. And again, a lot of those major cities are looking at 5% plus group business RevPAR growth, so that's also a good sign. Take a look at some individual markets. I think out of all the slides, this is my favorite because when I present this in person, you can see everybody on the audience looking at the map and squinting a little bit and going, "Now where am I? Where's my city?" And obviously, on this, the darker the green, the higher the RevPAR is above the previous peak of 2007, 2008, and the deeper the red is the lower it is from previous peak. And you can see here that green dominates the map, and this is this is a perfect snapshot of the industry of the past 5 years. I think everybody in these green areas has been very successful. A quick look at some of the general markets out there. The top markets, Macon, Warner Robins. I got to admit, I'm not sure what's going on there that would drive that RevPAR growth, but 19% year over year through November. And then you look at the right-hand side of the chart, and to no one's surprise, the majority of the markets on the losing end of the RevPAR game is their oil markets.
Right.
And I don't think anyone can be surprised. That's right. Shale and just the price.
Fracking.
I mean, Houston has just seen a tremendous drop, and a lot of that's because of the suppliers. They're downgrading, so then the companies themselves have to. So interesting to see this. You just look at that list and go, yeah, oil must be in the tank right now. No pun intended, but because the RevPAR growth in those markets, there is none. It's all on the downside. Take a look at the ADR for the same time frame, November year to date. Three markets on the left side there from California. Also have Portland in double digits, and of course Nashville, which has been going strong for several years. The hometown of STR, that new Omni there has really helped hoteliers there drive rates. And then on the other side of the coin, look at the ones that have seen the least amount of RevPAR growth, and in some cases decline in RevPAR. And New York is there, down a percentage and a half. So we'll talk a little bit more about that. You'll see New York through several of these slides. Higher occupancy equals higher ADR. That's pretty true in most markets these days, with one exception being New York. Still 85% occupancy, yet ADR is declining. It's a hard formula to figure out. If you're filling 85% of your rooms, you would think you still have pricing power, but apparently that's not the case there, and you can see that that bears out in these. So these are the top 25 markets only. So you see the top 5 and the bottom 5 performing markets in those. And again, Nashville, Phoenix, which we've talked about, San Francisco up there. You can't build a hotel in San Francisco these days. So the existing supply is what it is, and that gives people a lot of pricing power there. So Seattle and Tampa also pretty strong. And then we'll take a step down and look at the markets right below the top 25 to markets 26 through 50. And it's no surprise that you've got San Jose, Santa Cruz, Oakland, which are located around San Francisco, right? So there's, they're feeling the effect of that. They're joining in the fun. People are staying elsewhere because they can't afford to stay in San Francisco, and that helps the other markets jump up as well. And then look at the bottom. Again, a couple of oil markets in there, and I guess the silver lining in this chart is that even with this we'll call them middle-sized markets, they're all in positive range. No one had decrease in the ADR percentage, so that there is a positive there. Let's take a look at the pipeline. We've got the construction today will impact 26 and 2017. You can see the number of in construction. This is through these numbers are through December, so this is year-end December numbers. We crunched those a little bit earlier than the performance numbers. So year over year, 17+% increase in rooms in construction today than there was, or at the end of 2015 than there was at the end of 2014. So remember, going way back to the beginning of this. Yeah, supply, it's going to be an issue. We've got 140,000 rooms in construction right now.
Is there an assumption?
I'm sorry?
Sorry, Jeff. Is there an assumption that December 2014 number are the ones that opened in 2015? And then you're going to have another 140 that open next year?
Well, certainly the assumption is that the majority of those, yeah, you got the big monster hotels that are under construction, that may or may not open this year. So I would say the vast majority of those rooms will open this year.
By the end of 2016,
yeah. So, and then the number that's even, I think, kind of scarier is the next one. Those projects that are in final planning. So they've got all their permits, they've got their architect, their designer, they just haven't broken ground yet. A 47% increase year over year. So 180,000 of those sitting, waiting to get started under construction. Now we know all of those will not come to fruition. There will be, for whatever reason, some will fall off. But let's just say, for the sake of this conversation, it matches this year in terms of construction. Another 140,000 rooms then will come on in 2017 or 2018, and you're starting to, that's where you're going to start seeing the big effect of this. Right now, I guess the good news is that the number of proper projects in the planning phase is down 13%. But all in all, when you throw all those numbers together, you get about 470,000 rooms in the contract pipeline, which means the deals have been signed, and that's a 13.5% increase over the same time at the end of 2014. And then the unconfirmed, which we track, which haven't been announced yet, is at 6.5% growth. So, yeah, I'm a little concerned about where supply is going and where it's going to be in 2 years.
On those numbers, if you go back to that slide briefly, it's not an accumulative of 412 and 469 under contract in the pipeline. It's just the difference of some of those 412 opened up in 15, and then there's some new stuff going on. So it's not like you got 800, nearly 900,000 rooms opening, right?
Right, that's right. Some of that 412,000 is included in the 469,000.
Right. So they're still somewhere in that process, just farther along, possibly in 15.
Yeah, and I couldn't answer this off the top of my head, but there could be a fair amount that have stayed in the final planning stage from year to year. Just waiting to get final, to get the go-ahead to start construction.
Zoning or whatever,
Yeah. So this is the number, 69% of the rooms under construction right now are in those upscale and upper mid-scale segments. And remember the slide before where, those were the segments that were driving, demand growth. We're growing there. So there's more demand coming into those segments that are already driving, already getting a lot of demand. So it's going to be interesting to see how that gets absorbed. When you're talking about, about 70%. And, it's interesting. I did this presentation probably 3 months ago, and that number was 67%. So to grow by 2 percentage points that's short of a period of time, it just kind of makes me think. I wonder, that's a pretty robust full pipeline. It's going to be interesting to hear at Alice. We talked to a lot of guys who are building out there, and it's going to be interesting to hear what they have to say, how nervous they are about this much supply in those two segments.
Mm-hmm.
Just a quick look here. You can see the really thick blue line in the middle. That was 2015. The blue line right above that is 2006. Green is 2010, and the red is 2007. So you can see that we have, the number of rooms in construction right now is the highest it's been since 2010, going back to 2005. So I just thought this is a good representation of where we are. We're kind of in the middle, moving up of historically over the past dozen years or so. So, if I haven't said it, supply is a concern. And then there's plenty of cranes in the top 25 markets. We were talking a little bit about that or alluded to it earlier, Brandt. You can see here, these are arranged by the number of rooms that are actually in construction in these markets, not the percentage growth. So you can see New York, which we know we saw ADR down 1.5%, but yet there's 14,000 rooms under construction. What's that going to do to the ADR when those come online? Some people have a theory, and I can't say whether I agree with this or not. I'm probably not smart enough to really truly understand it. But some people's theory is that hoteliers have already started pricing for the onslaught of supply that's going to come on, that they're anticipating having to lower their rates, and they'd rather start gradually lowering it than have a big decline when all these properties come online. So
it doesn't seem logical to me, but
It does.
If you got
But
85% occupancy, you should be increasing your rates until you have to.
Can't argue with that, but I suppose if you have a GM that has been at particular properties for 25, 30 years or whatever, and they're looking ahead, trying to make sure they're getting taken care of down the road, they don't want to see a 12% drop in ADR. They'd rather see a 1% drop, a 1% drop. It's interesting. That market is just interesting in so many ways. And I think this number bears that out quite a bit. And you can see Houston. We talked about that oil market. Oh my gosh, it's at the depths right now, and yet there's 5,700 rooms under construction. How's that going to get absorbed in a market like that, where none of the, where people aren't traveling there for business as much because the oil markets are slow. So lots of construction in major urban markets. I think the number is 22, might be 20 of these markets are 2% or above supply growth. So something to keep watch of.
And then 2% is the long-term average.
I believe that
it's like a 20-year average.
The long-term average is like 1.8. I think it's 1.8.
Okay.
Yeah. So, and then this is just a different way to present that, just to kind of hammer home how much is going on in New York. I mean, all those other cities, the next three combined don't equal New York as far as the number of rooms under construction. So there's a lot of nervous people that probably get paid by RevPAR growth or ADR growth that are in New York. And I'm going a little too fast here. Sorry. Okay. I'm trying to click once. Okay. We'll just go to this one. So a shuffle coming in. I love this slide because it kind of shows, if you look at the orange part of it, that's what the current supply is. The green is what's under construction, and the blue is what's in final planning. So at the moment, New York is the third largest hotel market in the U.S. Vegas, Orlando, and New York. Once this flurry of activity is done, let's assume that's 3 or 4 years from now, New York will move up to number 2. You can also see Washington will bypass Chicago. So there'll be a little bit of a shuffling at the top as far as what the largest hotel markets are in terms of number of rooms in the U.S. So that's one of those tidbits that can win you a bet at a bar late at night, right? I told you before, so 50%, around 50% of the rooms under construction are in the top 26 markets, including Vegas. The rest of the U.S., you look at that the pink number in the middle, the final planning. There's a lot of rooms in final planning outside of the top 25, and I know a lot of the HBI brokers are in. Look at secondary and tertiary markets for business. That's probably the concern there is, how many of those are, I'm just throwing out a brand name here, a 90-room Hampton, that's going to go into a market that has 1,000 rooms to begin with or fewer. Your clients are going to be, kind of pinched with that, which may very well help business. They might get them moving to get off the dime and sell. Active pipeline for some brands here. You got Holiday Inn Express leading the way, Home 2 Suites, Hampton Inn, Fairfield, Residence, Courtyard. I'd say Hilton and Marriott pretty much have it covered up there. If you look at those brand names on the left, that's pretty much all of them except Holiday Inn Express. It's again just kind of an interesting slide that if I didn't know, I would be surprised that Holiday Inn Express was leading the way. This is transaction data from our Hotel Transactions Almanac, which we partner with HBI with. Thank you for being our partner on that. You can see we're forecasting that at the end of last year we'd have $24 billion in transactions in the U.S. And you can see the peak in 2006 was over 30 billion. So the trend is going up, and you guys can tell me better than I, but I've got to believe that we're going to see another bar above where we were this year in 2016. I got to believe it'll be more than 24 billion. Question is when do we reach? Are we going to reach that 2006 level? I know all you guys are rooting for it, right?
Yeah, yeah. No, I think we'd agree that 2016 will be ahead of 2015.
Yeah.
Probably need to wait another 10 months before we figure out where 17 goes.
Yeah.
Get an election over with and see where the interest rates are.
That's right. That's right. And you know that's a good point. There's going to be a lot of things hinging on this election, and you know, we'll see how it affects these transactions. So the average weighted price, the weighted average price per key, all-time high, $235,000 per key. Again, average. We know that this varies by market, by street corner, all of that. But interesting to see that it, you know, in 2000, when we came out of the recession, it went up in a hurry, then kind of flattened, and now.
Whoops. Jeff, we lost you. Jeff, your sound's been muted. Jeff, we still don't have sound from you. Jeff, can you? Jeff, there's no sound from your end. You may need to dial back in. Do you mind taking a pause and doing that? We obviously have an audio problem, and we're trying to get Jeff on. He, for some reason, cannot hear us, and we will allow him to move through the slides if that's what works out best, if he can't get back on. And then those listening will be able to at least see the slides, and it'll be recorded. And hopefully we can do something to the sound when we put this on live. But please bear with us, and we'll just look at the presentation. Looks like he's at the end. So please hold, and we'll see if we can get back on and review those slides that we lost his sound on.
Hello, Brandt. Are you there?
Yes, I'm there now.
Hi.
Did you dial back in?
I dialed back in. Of course, I kept talking for 5 minutes. But
Well, you did, yeah. when I was trying to move the slides back, that was me messing with you, trying to get you to look at the message.
Oh, I'm sorry.
I don't know what happened. It just went dead. So
okay.
I'm glad you're able to get back in.
Yeah, are we
We're back live.
now?
Yeah, everybody's listening. Let me go back. I'm going to move the slides back for us here, and just see if I can get back to about the point that I thought we lost you. It was right about this point. You were talking. I remember this slide. You were talking about how things had leveled off, and then we're now increasing again in value. And that was about the point in which, when you got to this slide, that we no longer heard anything.
Okay, so for all of you that know me, I did keep talking for like 7 minutes. So I really do like to hear myself talk. But it was good practice, right?
That's all right. It was good practice. Now you can do it. Now you can do it for real.
Well, thanks for hanging in there, everybody. I appreciate that. So we're looking at this slide where the average additional capital per key, the amount of money that a new buyer, a new owner puts into a property after they buy it, has significantly tailed off from 2012. Just exemplifies that so many properties were pipped and renovated previously, and now they're starting to sell again, and there's not as much needed to keep up the brand standards. So looking at the average cap rate at 8.5%, again, it's kind of leveled off over the last couple of years. We have clearly there's a distinction between cap rates of limited service and full service properties, but this is kind of blended, and we'll see how that all goes next year, because it'll obviously tie in then with the average interest rate, which is at about 5.2% for 2015. And Brandt, you hit it on the head a little bit earlier when you were talking about how the presidential election is going to potentially affect interest rates going forward once that's done. So it's going to be interesting to see where this red line is at this time next year. Or actually in 2 years is really when it's going to be telltale, right?
Right.
So we're going to look at the forecast here. This is a slide that I really like because we get a question a lot about how long does it take to recover from a down cycle. So if you look at the line that's going up, that's the average daily rate if it had grown by CPI. And I want to make that distinction. I need to change that headline. It shouldn't say inflation. It should say CPI growth. So this is the line is what ADR would have been if it grew by CPI. The gold
So it has
bar
gotten above that for this year, and is expected
right.
to climb even farther next.
That's right. The gold bar represents the actual ADR. So if you count those gold bars, the 7th year is the year that we finally went past the adjusted. And then if you look back at the last down cycle, it was 7 years before we recovered. So might be a slight stretch, but right now in our lifetimes, the average recovery period is about 7 years.
Yeah, I think there's a few different dynamics going on though. Currently, one, the growth of this period has been more level. You know, the growth in that last one really was 5, 6, 7, 8, that 4-year period. We still have the growth, but even in our economy, the economy has been stretched out on a slower growth. So I think some of the averages we see in these numbers are going to be mitigated a little bit by the different dynamics of the economic kind of cycle we're in. Maybe the circle's bigger. You know, how people talk about the 9-inning baseball game and the clock and whatever. I hear different speakers talking like that. I think instead of a 9-inning game, we might have a 16-inning game. Or I don't know what the number is, but it's longer than 9. And the same thing with the clock. The clock's not got 12 hours on it anymore. It's got 16 or 18 hours. So. So I do think this may not be totally indicative that we're on the downturn. There was a slide earlier I saw that would make me think, and I didn't say anything, but it looked to me like if you take the same concept we're doing with this picture and look at that one, it would be 2018 before you have a downturn. So.
Well, yeah. I mean, the obvious thing about this slide is that the 2 downturns were caused by an external event beyond anyone in our industry's control. So, assuming that nothing like that happens and it's allowed to play out at the pace that it naturally should, I think you have a valid look into 2018 or 19 before it really starts before it really starts getting affected by that oversupply and a slowing demand. Because you just, how long can you have demand growth at 4 or 5%? I mean, at some point, there's got to be a natural ceiling, and how close are we to that?
Yeah.
So, okay. Boy. Okay. All right. I'm pressing it once. Let me do it. Let me use my mouse.
There you go.
Maybe it's my. Okay, so here's the quick forecast for this year and for next year. The STR forecast. You can see we're pretty, still pretty bullish on a lot of sectors, particularly a lot of measurements, particularly ADR and RevPAR. Occupancy, occupancy growth we see dipping under 1% for the first time in a long time. Demand, again, starting to decline. We're starting to see down more towards 2% instead of 3%. And then this is broken down by chain scales. I'd like to point out here that we project that in 2015, we're going to see we see a lot more RevPAR growth at the lower end of the chain scales than the upper end of the chain scales, which I think is good news for a lot of brokers, especially if you start looking at T12 numbers for sales, because the sales at those, the numbers at those economy and mid-scale and upper mid-scale properties, you're starting to see some good numbers that you can put into the pro forma. And here's 2016, same thing, starting to slow down at that lower end relative to the upper end. It's not outpacing the upper end, or it won't be outpacing the upper end. We believe will be the case. And you can see, again, kind of looking at occupancy at that higher end, hard to grow when you have 75% occupancy to begin with. I mean, how much more can you realistically manage at that point? So we'll start seeing that tapering off. And I guess that's the question, Brandt, that you know, in this environment, in this world now where everything is so instantaneous and instantly analyzed, people can jump to conclusions because some people would argue, oh my goodness, the sky is falling, the luxury segment's only going to grow by 0.5%. Well, yeah, but it's still 75% occupancy. And,
Right,
you know,
right.
I think people are quick to jump the gun when they start seeing projections that show lower than the year before growth, but yet looking at the nominal numbers, it's still pretty healthy.
Well, yeah, and let's say occupancy were 0 growth, but stayed level, you're still able to, you know, move RevPAR by increasing your rate, even if it's, you know, 4 or 5%, it's still ahead of inflation. So, you know, people in general are still doing better. We'll still be doing
That's
better.
Right.
So,
that's right. That's right. So I think that's what, you know, kind of jumps out at this. This is the 3 companies that follow and project, you know, on a national basis regularly. You can see, just to point out, the numbers from STR and PwC are as of November. The ones from PKF are as of August. So I'm sure we're going to see updated numbers at Alice in 2 weeks.
mm-hmm.
But, you know, you can see, I'm not going to read every number, but one that stands out to me, PwC looking at flat growth, like you were just talking, for next year. Or pardon me, for this year, 2016. You know, they're looking at flat. And, you know, that's not something to be alarmed about, but it is something to watch.
Well, I mean, but then they still show a 5.7% RevPAR growth. So they're
Exactly.
more aggressive on ADR than you guys are. But the end result is the same growth of RevPAR. And
that's right.
That's really revenues. So, you know, that's a pretty strong growth if you're over 5%.
I don't know an owner that wouldn't take that year in and year out.
Right.
You know,
exactly.
over 5% growth. Sign me up for the next 30 years, right?
Right.
So I think, you know, just to kind of summarize, times are good. That's no surprise to anyone. The big question is, how long is it going to last? What's going to be the key situation that starts the downturn? Is it going to be, you know, some geopolitical event in the Middle East or in Russia, or a banking crisis, or, you know, a terrorist event, or will we have a soft landing that allows us to stretch this thing out to 2018 or 2019? I'm going to guess everybody's going to raise their hand with that as that option being the choice.
Yeah.
So, you know, if there's any questions, I can certainly answer those.
I think we've gotten those all asked. So we
Right.
appreciate you being here, Jeff. Always a pleasure. Our audience was more than just brokers today. We had management companies and hotel owners listening in. So I'm sure they appreciate all the information. It's a great update, and whether you're an operator or a broker, an owner, or a buyer, all this information was very good for everybody, and we appreciate your participation.
Well, thank you, Brandt, for having me, and thanks everybody for bearing with me on the technology side of things. That was, I'm sure, user error, so I appreciate you hanging in there. And for all of you going out to Alice, I'll see you out there in a couple weeks.
Yep, we'll see you out there. Let me just wrap up here. Don't forget to rate today's webcast by clicking on the Rate This button located at the top of the webcast player. You can download a PDF list of today's featured hotel listings, plus a selection of the additional hotel investment assets listed by HBI broker members under the Attachments button on the top of the webcast player. You can also access them at hbihotels.com. Click on the Share This button to share today's webinar with your colleagues. Pass it along so that they can view it on the web once it gets posted later today. And remember, this and previous Hotel Investor Marketplace webcasts are available for on-demand viewing at hbihotels.com, where you can register to join me next week on January 20th when I'll be talking with Dr. John O'Neill, Professor and Director of the Center for Hospitality Real Estate Strategy at the Pennsylvania State University. He'll be here to give a perspective on U.S. hotel operation issues, including such things as the impact of extreme minimum wage proposals and the effect of resort fees and other surcharges. So join us next Wednesday, January 20th, for that webinar. Before we go, I'd like to remind you of our exhibit calendar. HBI serves as a supporter of the ALICE conference, which will be held in Los Angeles in 2 weeks, January 26th and 27th. HBI will be exhibiting at the Hunter Hotel Investment Conference in Atlanta, March 16 to 18. And we will also be exhibiting at the HOA Annual Convention held in Nashville on March 29th through April 1st. So please look for us, come by the booth, say hello, give us some feedback about the webinar and any suggestions you might have for future ones. We appreciate everybody's attendance today, and we apologize for the little hiccup on the operations, but it all turned out well, and we again thank STR and Jeff Higley for joining us today. Everyone have a good day and the rest of the week. Thank you.